Every month you check your bank balance. You see numbers on a screen. Your money, right? Wrong. Legally, that money belongs to your bank, not you. And when the next financial crisis hits, they can take it. All of it. Completely legally. Most people have no idea that the moment you deposit money into a bank account, you no longer own that money. You become an unsecured creditor to the bank. The bank becomes the legal owner. This isn't theory. This isn't conspiracy. This is established law, confirmed by court cases, written into banking regulations worldwide, and it's already happening. In 2013, Cyprus seized deposits directly from bank accounts. In 2015, Greece froze all accounts indefinitely. In 2019, Lebanon confiscated deposits to prop up failing banks. Millions of people lost their life savings overnight, not through bank failures, through bank theft, legal theft. The system was designed this way. For centuries, banks have convinced people they're storing money when they're actually confiscating it. And now, with digital currencies and cashless systems, the trap is closing completely. This is the story of how banks legally stole ownership of your money, why governments help them do it, and why the biggest wealth transfer in history is coming for your deposits next. The year was 1202. Venice was the richest city on earth. Merchants from across Europe brought gold and silver to Venetian banks for safekeeping, and for the first time in history, banks started lying about what they were doing with that money. Before Venice, banking was simple. You gave a goldsmith your coins. He put them in his vault. You got a receipt. When you returned with the receipt, you got your exact coins back. This was called bailment. You owned the money. The goldsmith was just storing it. Everyone understood this. But Venetian bankers noticed something. Most depositors never came back for their gold at the same time. On any given day, only 10% of depositors wanted their money. The other 90% just left it sitting in the vault. That idle gold was too tempting to resist, so they started lending it out. Your gold lent to someone else, earning interest for the bank. At first, they only lent small amounts, but the profits were enormous. Pure profit from money that wasn't even theirs. And depositors never knew because their receipts still promised the same amount of gold. This was the moment everything changed. Deposits were no longer about storage. They were about lending. But banks never told their customers. The receipts still looked the same. The promises still sounded the same. But legally, everything was different. The Medici Bank perfected this system in the 1400s. They created the first modern deposit accounts. When you deposited gold with the Medicis, you weren't storing it anymore. You were lending it to them. They became the owner. You became a creditor. But the bank documents were deliberately vague. They used language like account and balance instead of debt and loan. Customers thought they were renting vault space. They were actually making unsecured loans to bankers. The difference is everything. If you rent a safety deposit box and the bank fails, you keep your property. If you make a loan to a bank and it fails, you lose everything. Within 2 centuries, every major bank in Europe had adopted this system. Fractional reserve banking, they called it. A fraction of deposits kept in reserve. The rest lent out for profit. But they never called it what it really was. The legal confiscation of depositor ownership. The Great Deception had begun. And customers, trusting their banks, walked straight into the trap. For 6 centuries, the legal status of bank deposits remained murky. Banks acted like they owned deposited money. But the law wasn't clear. Customers assumed they retained ownership. Courts hadn't decided. Then in 1848, one lawsuit changed everything forever. David Foley had deposited money with Whitehead and Company, a London bank. When the bank failed, Foley demanded his deposits back, claiming they were his property held in trust. The bank's receivers argued differently. They said the deposits were loans to the bank, making Foley just another creditor in bankruptcy. The case went to the House of Lords, Britain's highest court. The decision would define bank deposits for the entire English-speaking world, and the judges ruled against depositors completely. Lord Cottenham delivered the verdict that legally stole your money. When you deposit funds in a bank, he declared, the money becomes the absolute property of the banker. You are not storing your money, you are lending it. The bank doesn't owe you your specific coins back. They owe you a debt equal to the amount you deposited. Think about what this means. If you put £100 in a vault for safekeeping, you own those specific coins. If the vault is robbed, the owner of the vault compensates you because your property was stolen. But under Foley versus Hill, when you deposit £100, the bank owns it immediately. If the bank is robbed, you lose your money because it was never yours to begin with. The legal distinction is between bailment and debt. Bailment means temporary custody. You remain the owner. Debt means you've made a loan. The borrower becomes the owner. Banks convince the courts that all deposits are debts, never bailments. This wasn't an accident. Banking lawyers had argued for this interpretation for decades. They needed legal cover for fractional reserve lending. They couldn't lend out money they didn't own. So they had to own all deposits. Foley versus Hill gave them that ownership. But banks never explained this to customers. Deposit agreements still used language like your account and your balance. Marketing materials promised safety and security. Banks deliberately maintained the illusion that depositors retained ownership while legally ensuring they didn't. The framework was now complete. Banks could take your money the moment you deposited it, lend it out for profit, and you had no legal recourse. And every English-speaking country adopted this precedent as their own law. The theft was now completely legal. American banking operated differently from Britain for over a century. State laws varied. Some recognized deposits as bailments. Others followed the English debt model. But in 1913, everything changed. The Federal Reserve Act centralized American banking under one system. And that system chose the model that benefited banks, not depositors. The 1930s made it official. Bank failures were destroying public confidence. Depositors were pulling their money out en masse. So Congress passed the Banking Act of 1933. They sold it as depositor protection. It was actually the opposite. The Federal Deposit Insurance Corporation was created with brilliant marketing. Government insurance for your deposits, they promised. Your money is safe up to $2,500 per account. Later raised to $10,000, then $100,000, now $250,000. Sounds protective, right? Wrong. FDIC insurance doesn't protect your ownership of deposits. It protects banks from depositor runs. Here's how the scam works. When you deposit money, the bank immediately owns it under Foley versus Hill precedent. You become an unsecured creditor. If the bank fails, you don't get your money back because it was never yours. You get an insurance payment from FDIC, but FDIC insurance has a cap. Above $250,000, you get nothing. Why? Because the law recognizes that large deposits are investments, not storage. You're lending to the bank. Investments carry risk. If you lose money above the cap, that's your problem for making a risky investment. The banking regulations made this crystal clear. Federal law defines bank accounts as demand deposits, not stored money, not held property. Deposits, money given to the bank. The legal language is deliberately precise. Look at your bank statements. They never say you own the money. They show account balance or available balance. Balance means what the bank owes you, not what you own. It's their debt to you, recorded on their liability ledger. When you write a check, you're not spending your money. You're authorizing the bank to reduce their debt to you and increase their debt to someone else. The Federal Reserve System completed what Venetian banks started 7 centuries earlier. Fractional reserve banking became mandatory. All deposits became bank property immediately, and government insurance created the illusion of safety while legally cementing bank ownership. Americans thought they were getting deposit protection. They were actually getting the final legal framework that guaranteed banks would own their money forever. The Federal Reserve didn't just control money supply. It officially transferred money ownership from depositors to banks. Cyprus, 2013. The global financial crisis was grinding on. Cypriot banks were failing. The government was desperate. And then they did what governments always do when they run out of money. They took it from depositors. On March 16, 2013, every bank in Cyprus closed. When they reopened, the rules had changed forever. All deposits above 100,000 euros would be seized, not taxed, seized. Depositors would receive worthless bank shares in exchange for their life savings. Panic erupted. People rushed to ATMs only to find withdrawal limits of 100 euros per day. Bank branches were surrounded by riot police. Depositors who had millions in their accounts could access almost nothing. The government called it a bail-in. The media called it unprecedented. But legally, it was completely legitimate. Here's why. Under the legal framework established centuries earlier, those deposits belonged to the banks, not the depositors. When Cypriot banks failed, depositors were unsecured creditors. In bankruptcy, unsecured creditors get paid last, if at all. The seizure wasn't theft, it was debt collection. Laiki bank customers lost everything above the insurance limit. Bank of Cyprus depositors lost 47.5% of uninsured deposits. Overnight, no warning, no legal recourse. because they never owned that money in the first place. But Cyprus was just the beginning. Greece followed in 2015. Capital controls froze all bank accounts indefinitely. Daily withdrawal limits dropped to €60. International transfers were banned. Depositors couldn't access their own money for months. Again, completely legal under banking law. Lebanon proved the pattern in 2019. Banks simply stopped allowing withdrawals above small amounts. Deposits exceeding $1,000 were frozen indefinitely. People with millions in Lebanese banks became cash poor overnight. The banks called it liquidity management. Depositors called it theft. The law sided with the banks. Each crisis followed the same script. Banks fail or face failure. Governments impose emergency measures. Deposits are frozen, seized, or converted to worthless assets. Depositors lose their savings. And every action is legally justified because depositors are creditors, not owners. The precedent is now established globally. Bank deposits can be confiscated whenever governments decide it's necessary. The legal framework exists. The political will exists during crises. And depositors have no legal standing to object because they never owned the money they thought they deposited. Cyprus, Greece, and Lebanon weren't anomalies. They were proof of concept. When the next banking crisis hits, your deposits will be the first target because banks don't confiscate your money. They collect on debts you didn't know you owed. Physical cash was the last refuge for true ownership. If you held paper bills or coins, you actually owned that money. Banks couldn't seize it. Governments couldn't freeze it. It was yours. But over the past 20 years, cash has been systematically eliminated, and with it, any remaining ownership of your wealth. In 2000, over 60% of transactions were cash. By 2024, that number fell below 10%. COVID-19 accelerated the change dramatically. Businesses refused cash for health reasons. Governments promoted contactless payments. Banks pushed digital wallets. Cash became suspicious, inconvenient, outdated. But digital payments aren't ownership transfers. They're ledger adjustments. When you pay with a debit card, no money moves. Your bank reduces the number in your account. The merchant's bank increases the number in theirs. You're not spending your money because you don't own any money. You're authorizing banks to adjust their debt obligations to you and to the merchant. This gives banks unprecedented control. Physical cash transactions were final. Once you handed someone a $20 bill, the transaction was complete. But digital transactions can be reversed, frozen, or blocked at any time. Banks can decline your card. Payment processors can freeze your account. Governments can monitor every transaction in real time. Sweden led the elimination of cash. By 2023, only 2% of Swedish transactions used physical money. Most Swedes haven't touched cash in years. The government calls this progress, financial inclusion, modernization. But Sweden now has zero true ownership of wealth. Every krona is controlled by banks and monitored by authorities. China perfected digital financial control. Their digital yuan allows the government to program money with expiration dates, spending restrictions, and geographic limits. Money that disappears if not spent quickly. Money that can't be used for unapproved purchases. Money that reports every transaction to authorities immediately. This isn't currency. It's a digital control system. The COVID lockdowns proved how quickly cash disappears. Within months, businesses across the world stopped accepting physical payments. Apps like Venmo, Cash App, and Zelle became essential. But these apps don't transfer ownership. They're just user-friendly interfaces for bank ledger adjustments. Each digital transaction strengthens bank control over your wealth. Cash could be hidden, hoarded, or transferred privately. Digital money exists only in bank computers. It can be monitored, controlled, or eliminated instantly. You can't hide digital money from authorities. You can't withdraw it during bank runs. And you can't own something that exists only as numbers in someone else's database. The elimination of cash wasn't about convenience. It was about eliminating the last form of money people could actually own. Central bank digital currencies are being marketed as the future of money. Faster payments, lower costs, financial inclusion. But CBDCs aren't money at all. They're programmable control systems disguised as currency, and they represent the complete elimination of financial ownership. China launched the digital yuan in 2021. The government called it convenient and modern. But the digital yuan has features no real currency has ever had. It expires if not spent within predetermined timeframes. It can be programmed to work only at approved merchants. It reports every transaction to authorities instantly, and it can be deleted from your digital wallet remotely without warning. This isn't currency. This is a social control mechanism. Chinese authorities can now monitor every financial transaction in real time, restrict purchases they disapprove of, and punish political dissidents by simply turning off their money. Criticize the government? Your digital yuan stops working. Miss a social credit payment? Your money expires faster. Support the wrong cause? Your spending is geographically restricted. The European Central Bank is developing identical technology. The digital euro will have spending caps, transaction monitoring, and programmable restrictions. ECB officials admit they're designing features to prevent bank runs, control inflation, and influence consumer behavior. They're not creating currency. They're creating a financial prison. The Federal Reserve is building the same system for America. Fed officials claim the digital dollar will complement cash, not replace it. But every CBDC pilot program worldwide has eliminated cash acceptance wherever digital currency is tested. Once CBDCs launch, physical money disappears quickly through regulatory pressure and merchant requirements. Here's how CBDCs complete the ownership theft. With traditional bank deposits, you're an unsecured creditor to your bank. You don't own the money, but banks have some legal obligations to you. With CBDCs, you're not even a creditor. You have no relationship with any institution. The central bank controls your money directly and can modify, restrict, or delete it for any reason. CBDCs also eliminate banking privacy completely. Cash transactions were private. Bank deposits required warrants for government access. But CBDC transactions are government transactions from the start. Every purchase, every payment, every transfer flows through central bank computers. Privacy doesn't exist because the government is the payment processor. The timeline is accelerating. Over 90 countries are developing CBDCs. The Bank for International Settlements coordinates global implementation. The International Monetary Fund requires CBDC adoption for future lending programs. Countries that resist will be excluded from international finance. Within 10 years, most nations will have replaced cash and traditional banking with CBDCs. When that happens, true ownership of money will be extinct. Not reduced, not regulated, extinct, because you cannot own something that exists only as programmable code in government computers. The final takeover isn't coming. It's here. You think you understand your bank account. You see numbers on your phone. You make withdrawals. You write checks. But read your deposit agreement. Actually read it. The legal language reveals exactly who owns what, and it's not you. Wells Fargo's deposit agreement states clearly that funds in your account are general liabilities of the bank. Bank of America's terms specify that deposits become obligations they owe you, not property you own. Chase's agreement explains that your account represents their debt to you. The language is precise because the law requires honesty about ownership. But banks deliberately obscure this in marketing. They use phrases like your money and your account in advertisements while their legal agreements say the opposite. This isn't accidental. Banks need customers to feel ownership while legally ensuring they have none. Look at your account statements. You'll never see the word owned anywhere. Instead, you see available balance and current balance. Balance means debt. It's what the bank owes you, not what you possess. When your balance is $1,000, the bank owes you $1,000. You don't own $1,000. The difference becomes critical during crises. Available balance can become unavailable instantly. Banks can freeze accounts, impose withdrawal limits, or offset your balance against other debts you owe them. They can do this because the money is theirs, and they're simply managing their own obligations to you. FDIC insurance caps prove this ownership reality. Why would deposit insurance have limits if deposits were your property? If someone steals your car, insurance doesn't cap coverage based on the thief's financial condition. But deposit insurance caps exist because deposits above the limit are recognized as unsecured investments, not stored property. Bank bail-in regulations make this explicit. Under Dodd-Frank and similar laws worldwide, deposits above insurance limits can be converted to bank stock during failures. This is legal because depositors are creditors, not owners. In bankruptcy, creditors receive equity in exchange for debt forgiveness. Owners would simply reclaim their property. The legal framework already exists for mass deposit confiscation. Basel III banking regulations require banks to maintain minimum capital ratios. When banks fall below these ratios, bail-in provisions activate automatically. Deposits above insurance limits become immediate targets for conversion or seizure. Your deposit agreement also includes offset clauses. If you owe the bank money through credit cards, mortgages, or other loans, they can seize your deposits to cover those debts without notice. They don't need court orders because they're offsetting debts they owe you against debts you owe them. Simple accounting. The rules are their rules because the money is their money. You're playing a game where you don't understand the actual terms. The next financial crisis won't be like 2008. Banks won't be bailed out by governments this time. They'll be bailed in by depositors. The legal framework is complete. The precedent is established. And the mathematics make it inevitable. Global debt has exploded beyond any possibility of repayment. Government debt exceeds $100 trillion worldwide. Corporate debt is at historic highs. Household debt crushes entire generations. When this debt bubble collapses, governments won't have the resources to rescue failing banks again. They'll take the money from depositors instead. The Bank for International Settlements has already written the playbook. It's called the Total Loss Absorbing Capacity Framework. When banks face failure, deposits above insurance limits automatically convert to bank equity or disappear entirely. No political debate, no congressional votes. It happens automatically through pre-existing regulations. European Union law makes this explicit. The Bank Recovery and Resolution Directive requires deposit confiscation before any government assistance. Deposits above 100,000 euros are the first target. The law is already passed, already implemented, waiting for the next crisis to activate. The United States follows the same model. Dodd-Frank's Orderly Liquidation Authority gives regulators power to seize deposits during bank failures. The Federal Reserve's emergency powers include deposit freezes and confiscations. These aren't theoretical authorities. They're established law, ready for immediate use. But most depositors remain completely unaware. They see FDIC insurance and assume their deposits are protected. They don't realize insurance only covers basic amounts. They don't understand they're unsecured creditors. They don't know their legal rights were eliminated centuries ago. The trigger will be another banking crisis. Rising interest rates are destroying bank balance sheets. Commercial real estate is collapsing. Regional banks are failing monthly. When enough banks fail simultaneously, the system will activate deposit confiscations to preserve financial stability. Cyprus, Greece, and Lebanon were rehearsals. The main event approaches. 3 scenarios are possible. First, gradual confiscation through bail-ins during individual bank failures. Depositors lose money bank by bank until confidence collapses completely. Second, sudden systemic confiscation during a weekend bank holiday. Depositors wake up Monday morning to find their accounts seized or converted to bank stock. Third, controlled confiscation through CBDC implementation. Cash and deposits are replaced by programmable digital currency that governments control completely. All 3 scenarios end the same way. Depositor ownership disappears. Wealth is transferred from individuals to institutions. And the legal system supports every action because the framework was built to enable confiscation, not prevent it. The pattern that started in Venice 800 years ago reaches its logical conclusion. Banks own your deposits. They always have. And soon, they'll prove it.